Let's talk about how to pay less taxes with a general partnership. So here's an overview I want you to pay attention to. So before I actually talk to you about how to reduce your tax obligations with a general partnership, I want to define a little bit the concept of a general partnership, okay? So when you think about a general partnership, I want you to think about a business arrangement by which two or more individuals agree to share responsibilities, assets, profits, and financial and legal liabilities of a jointly owned business. So in a general partnership, partners generally agree to be personally responsible for potentially unlimited liability. So liabilities are not capped as they would be in, say, a partnership formed as a limited liability partnership or a limited liability company, LLC. Partners actually are responsible for the debts, and the seizure of an owner's asset is a possibility, okay? So furthermore, any partner may be sued for the business's debts. So since a general partnership is a pass-through entity where income flows straight to the owners, each partner reports their share of partnership profits or losses on their personal tax return. So the partnership itself is not taxed. So if we're talking about a general partnership, you do not pay taxes at the general partnership level, okay? So think about the fact that when you have a general partnership, you have to have a written partnership agreement, so you can actually avoid certain conflicts. And general partnerships are less expensive to form compared to a corporation. And it's one of those things where you want to make sure that you're covering your assets, you're covering your butt in terms of legal liability, because partners assume unlimited liability, potentially subjecting their personal assets to seizure if the partnership becomes insolvent. So there's a risk there. So one thing I want to say here is that when we talk about general partnership, it must include a minimum of two people, and all partners must agree to be personally liable for any and all liabilities that the partnership may incur. So you got to have things like partnership agreement. You got to think about the management of the company. So basically things should be clear about how a partnership will be created, the rights and duties of partners, partnership assets and liabilities, financial duties of partners in the partnership, and profit allocations and voting rights. Those should be actually in the documents. Okay, very important. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. So when we talk about paying less taxes with the general partnership, you need to understand that the general partnership actually have been around for many years now, many decades for that matter. When you think about the sole proprietorship version of when you have two or more people who are when you have one entrepreneur, it is actually a sole proprietorship. When you have more than one, then you actually have a general partnership. So for example, law firms, medical practices, and architectural firms often organize themselves as general partnerships. Spouses and other members of families who want to run a business together also set up general partnerships, okay? And so general partnerships have been the business entity of choice for individuals seeking to work together, as well as various types of service providers. That's often due to their straightforward structure, low cost, and ease of setup, okay? So there are advantages. As we try to really pay less taxes with a general partnership, we need to understand that general partnerships have pros and cons, right? So let's talk about the pros first. So a general partnership is less expensive and easier to set up than a corporation or LP. So basically, when it comes to taxes, you don't owe that many taxes at the partnership level. You have less paperwork involved, especially when it comes to taxation. In the U.S., filing partnership paperwork with a state is generally not required, though certain registration forms, permits, and licenses may be necessary at the local level. As a pass-through entity, the partnership pays no taxes, and so no external financial reporting. Annual report is required, and a general partnership is simple to dissolve. Now, let's talk about the disadvantages. So you have personal liability that's unlimited, especially when it comes to taxes. A partner's personal property can be seized to pay a partnership debts. With a shared liability, partners must deal with the financial and legal and tax consequences of each other's and employees' actions. Disputes may be difficult to address and disastrous for the business unless properly planned for in the partnership agreement. That's what a partnership agreement is really important. And over time, a business can become complicated, encounter greater risks, increase potential personal liability, and outgrow the general partnership structure. So it's one of those things where a partnership, it really is great, but it's not the same thing as an LLP or an LLC. Okay, very important. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about how to pay less taxes with a general partnership. Let me talk to you about the approach you need to follow here if you're trying to pay less taxes with a general partnership. It's important to understand that, first of all, you got to understand how partnerships are taxed. So as is the case with a sole proprietorship, a general partnership is considered a pass-through entity for tax purposes. In other words, the partnership itself is not taxed, but each partner is responsible for reporting their own profits or losses, if you will, from the business on their individual tax returns. So a clear advantage to the general partnership taxation method is that the profits in your partnership are only taxed once. This is opposed to a corporation where you have double taxation, okay? So you need to have a written agreement because you want to make sure that taxes and transactional items are really clearly explained and are clearly handled when it comes to taxes, but also when it comes to operational efficiency. And you have to also understand that if you are trying to pay less taxes illegally, of course, with a general partnership, you need to understand how profits are distributed in your partnership. So profits in a partnership are divided amongst the partners according to the partnership agreement and can be either distributed to the partners or reinvested back into the business. This is where the partnership agreement can be a valuable time saver. So without an agreement that details the allocation of each partner's distributive share, this amount must be calculated using other variables, and this may include the partner's service contributions and capital investments. And one thing I want to mention here is that not all distributions have to be equal in your partnership. Just because both business owners put in 50% of the business's capital does not automatically entitle them to receive 50% of the profits. Instead, the partnership agreement can stipulate that the partner receives a specific percentage of the partnership profits regardless of their initial investments. So this is kind of important. And so you just have to understand that even though I'm talking about 50-50 or 60-40 or 70-30, you have to keep in mind that just because the partners did not take a distribution doesn't mean they don't pay income taxes on them. Instead, the profits are considered allocated and Uncle Sam still gets his cut anyway. So let's talk about if you want to pay less taxes with general partnership, you need to comply with all the rules and regulations that relate to your specific field. So when we talk about filing taxes for a general partnership, we're talking about IRS Form 1065. So the allocation of profits or losses for all partners is calculated and recorded on Form 1065 at the end of each fiscal year. So just make sure when you actually fill out that form, make sure that you do not make any mistake, because otherwise you'll end up paying more taxes with a general partnership. So if you're trying to really pay less taxes with a general partnership, be very clear be very thorough when you actually fill out Form 1065. Okay. Now, when you file Form 1065, this is an information return. So you're just informing the IRS what's really happening in your general partnership. The general partnership in itself is not paying taxes at that level. You got to think about Schedule K1. So Schedule K1 is important because when you file a Form 1065, you got to really accompany that with Schedule K1. You have to distribute that to all the partners. See, we're talking about a general partnership. So all the partners are basically risking their own assets, their own life. I mean, not their own lives, but their own assets, their own financial standing. So they need to actually be kept in the loop. So separate Schedule K1s are filled out and distributed to each partner. A Schedule K1 details their share of the income, credits, and deductions that each partner reports on their individual income tax returns. So this is kind of important. And one thing I want to say here is that it doesn't matter if you have 1,000 partners in the general partnership or you have 10 partners. You got to really send out Schedule K1 to all partners in the partnership, and they have to receive that Schedule K1 by March 15th. So the deadline here is March 15th. And that's one of those things where you have to understand that deadline for a C corporation's return is April 15th, but for an S corporation is March 15th, where you have to file your individual, like you have to file your taxes, your S corporation taxes. Again, we're talking about S corporations, so you're not paying taxes at the not S corporation. I'm talking here about partnership. I mean, so for the partnership, you have to really make sure that you send your Schedule K1 early so that the partners can actually file their individual return. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about how to pay less taxes with a general partnership. If you want to pay less taxes with a general partnership, you need to actually be on top of your estimated taxes. You got to be on top of your self-employment taxes. You got to really understand. So let me just talk a little bit about that. So paying estimated taxes. So since federal income tax is not withheld from the distributions, individual partners are responsible for their own tax payments. Pretty simple as that. This is where quarterly estimated taxes enter the picture. But the thing is that you have to actually use a worksheet included on page 8 of 1040 ES. So that's the federal form. You can also you can use there is on the IRS website, there's an estimated quarterly tax calculator that really breaks things down for you. You also have to think about self-employment taxes. So most employees pay into the Social Security and Medicare programs through payroll deductions. Partners, on the other hand, do not receive paychecks. So they are required to submit this payment to the IRS in the form of a self-employment tax on their allocated profits. Although this tax is filed along with your annual income taxes, it is not taxed the same way. So what happens here is that the self-employment tax rate is 15.3% of net earnings of $400 or more. So this rates combine both the Social Security and Medicare contributions at 12.4% and 2.9% respectively, okay? So it's really important. So the catch to paying self-employment taxes as partners is that you are paying double. This is because the 15.3% is normally split 50-50 between employer and employee. So, but without this arrangement, partners are on the same line actually for the entire amount. Fortunately, you can deduct half of your self-employment taxes from your own taxable income to compensate for the added amount. So this is kind of important. So Schedule SE, you have to remember that. So self-employment taxes are filed annually using Schedule SE along with your Form 1040. So I think basically in terms of the general partnership tax deadlines, do not forget if you're trying to really pay less, it's April 15th, June 15th, September 15th, and January 15th. Let me give you a bonus here. So it's really important to understand that if you're trying to really pay less taxes with a general partnership, you got to understand that partners pay taxes on their share of the profits, okay? A partnership, the general partnership, is not taxed as a business entity. So the partners actually are on their share of the profits, and everything happens through the written agreement, the written partnership agreement. And it's one of those things where partners are considered self-employed. So basically, each partner is treated as self-employed by the IRS. Thus, they are liable for self-employment taxes such as Social Security and Medicare withholdings. That's just what I would explain to you a little earlier. And so you need to understand that it's one of those things where you have to keep track of your tax withholdings or your tax due. And the thing is that you need to understand that if you're a partner, you're paying double, right? Because normally employees are getting a match from their employer contribution, but in your case, if you're a general partner, you do not actually have that match. Also, think about expense deductions. If you're trying to really pay less taxes with the general partnership, you got to really think about expense deductions. We're talking about all kinds of deductions that can be applied against the business profits, thus reducing the amount of profit that needs to be reported to the IRS, right? So we're talking here about all kinds of general partnership, normal and necessary business expenses. They have to make sense to your niche. They have to make sense to your industry. They have to make sense to, like, when the IRS analyzes all similar tax returns, it has to make sense. And so one thing I need to say also, that when we talk about how to pay less taxes with the general partnership, obviously all the tricks, all the tips, all the hacks that you apply at the federal level, you can also adapt them to to your state filing process. So when you actually are thinking about how to actually do things on a specific way, you got to really understand what really happens, what really matters for your business, for your general partnership, and all the states where your business partnership, or your general partnership, that is, where your general partnership is operating. If you are operating in multiple states, then you have to adapt a multi-state strategy. It's just what it is. Let me give you a winner here. So if we are trying to reduce the amount of taxes we pay with the general partnership, it's important to really to analyze the general partnership type of structure and see whether or not it is still accommodative, whether it is still adapted to your ability or your willingness, that is, to actually pay less taxes with the general partnership. In some cases, you might actually think, you know what, I think general partnership is kind of cool, but now we want to switch to a limited partnership. Obviously, when you have that kind of decision, it has to be like all partners must ratify the decision. All partners must sign the decision to actually make it into reality. And you need to really understand also is that the best way for you to actually pay less taxes with a general partnership is actually to keep good record keeping. You got to really have a written agreement so that everything is clear when it comes to business deductions. Okay, that every partner can take their portion of the profits or income. Gains, they will need to report their losses and credits. So if you have a properly written sort of partner agreement, everything is clear to everybody. That's really cool. That's really good. And one thing I want to say here is that, you know, when it comes to taxes and a general partnership, you need to understand that everything happens at the individual level, right? So you're not actually, your general partnership will never pay taxes to the IRS directly, because the IRS treats the whole thing as pass-through taxation or disregarded entity. So the IRS treats your general partnership as a disregarded entity unless you actually elect to file a C corporation or S corporation, for instance. Okay, but if you don't do anything, you only file in a Form 1065, and it's one of those things where Form 1065 actually allows you to actually. Form 1065 is not really. It's not really equivalent of a disregarded entity. Disregarded entity is better for single member LLC, sole proprietorship, and in some cases you have a single shareholder S corporation. So when you have this sort of configuration, the IRS is looking at your records and thinking you are a disregarded entity, and they treat you that way. So disregarded entities is not a bad thing. It just means that the IRS, in the eyes of the IRS, you're not filing a corporate tax returns separately. You are filing at the individual level. You just happen to report your business income, your general partnership income, on your Schedule C. So this is what it is. Thank you so much for your attention. I really appreciate it. In today's conversation, I'll just explain to you how to pay less taxes with a general partnership. So let's do a quick recap here. So I give you the overview, the approach that you need to follow, the bonus, and the winner. Thank you so much. God bless you. I'll see you next time. Until then, remember, stay marvelous.